Hello, and thank you for joining Key Performance Indicators with Dr. David Kelling. I'm Nicole Cass, the CE Program Manager for the MVMA, and I'm pleased to be your moderator. If you have any questions during the session, please type them in the Q&A area. A quick reminder of the WebEx platform so you can actively participate. To ask a question or join in the conversation, please place your cursor on your screen. Along the bottom, you'll see a series of circles. Look for the black circle with the three dots, and if you click on it, you'll see a little Q&A, and you can click on that and a pod will open up for you to type in your question. I'd like to introduce today's Lunch and Learn speaker. Dr. David Kelling is a partner at Kelling, Bakovich and Company Limited. He earned his BS in Accounting and Finance from Mankato State University. Mr. Kelling also earned his master's degree in business taxation from the University of Minnesota. I'd like to turn it over to Dr. Kelling.
Thank you, Nicole. I'm gonna get my screen shared here. There's that, looks like it's showing up now.
Yes, it is.
Great, and thank you for everyone else for taking time out of your busy schedule to take an hour here to talk about key performance indicators and how they can help you improve the management of your practice. A little background on our firm. Our firm specializes in advising small businesses and helping them with their accounting, tax, and payroll needs. And we recently got into working with veterinary practices. It's sort of a combination of a few factors. I did grow up on a farm in southeastern Minnesota and always been around animals and helping care for them. I obviously do like numbers as I'm a CPA, and tax forms do not seem like a second language to me. The last piece that sort of brought around us working with veterinary practices is my daughter starting work on her doctoral for veterinary medicine. We had a bit of a conversation about how she would never become an accountant and follow in my footsteps. Accountants were way too boring, she said. I sort of countered with any profession with needles and sharp objects I would have to pass and sort of stick to my spreadsheets. So that's sort of how we started working with veterinary practices. I just decided that I could use my business and accounting knowledge to help your profession. And so we went along developing a system with today's technologies to help you be your back office support and let you get back to working on your practice. All right, KPIs. What is a KPI? Key performance indicator is a measurable value that demonstrates how effectively a practice is achieving a business goal. They're evaluated over a specific time period, but they must be compared to past performances and/or industry standards or norms. They should lead you to questions about your practice and help narrow the focus and help determine what actions are needed. Now, there are a multitude of KPIs. I think if you gave me an hour, I could probably come up with over 100. And it can get really overwhelming. My suggestion is that you try to pick out 5 to 7 that really matter and fit the goals that you're trying to achieve and hone in on those. They may need to change over time as your goals change or as certain events happen. The other thing to keep in mind is that there's not a set group of KPIs just for veterinary practices. There are going to be different depending on your practice. Examples would be if you have large animal versus small animal practices, you're going to have the need to look at a few different things. Looking at the top KPIs here, I've sort of broken this down into 5 groups: active patient KPIs, staff production, inventory optimization, financial KPIs, and then veterinary production. The approach I'm sort of going to take here is we'll go over first what information you'll need for each group, then go over each of the KPIs in that section, sort of how they're calculated, and then we'll sort of go back to the why we're looking at these in particular and what actions you might end up taking based on them. also have a number of industry averages. I believe Nicole shared a spreadsheet that I've been putting together, and I'll try to make sure to point those out just so you can give a baseline or an idea of what other practices might be doing. First group is the KPIs revolving around active patients. Information you're really going to need here is a client or patient list from your practice management software. We want to be able to figure out the number of active patients by species. And generally, active patients is defined as one that has visited in the last 18 months. We're also going to want to be able to figure out number of new patients and then the number of lost patients. Okay. All right, for this area, the KPIs, like I said, the first one we really want to watch here is number of patients visits per month or per year. The national average of patient visits per month is 150 per veterinarian. The next one we're looking at is the number of new clients. And that average is about 20 a month per full-time veterinarian. And then the third one we want to calculate is the revisit rate per year. What you're going to do there is take the total number of visits divided by the number of active patients. And you're definitely looking for a trend to be +1 there. And the other, another one to watch is your species counts, just so you sort of have an idea of what your practice makeup is. And then the last one is patients lost, and you definitely want to be able to track the reason that they're no longer a patient. So why are we looking at this group? It really lets you know if your practice is growing or shrinking, and what areas are growing or shrinking. You want to make sure your new patients being added are outpacing the lost patients. As a general rule, about 20 to 25% of your revenue comes from preventive care or reoccurring revenue streams. And although it's only less than a quarter of your total revenue, it does sort of work as a feeder program and helps develop client loyalty. If you start to do a little math there and you see your average visits are 150, but the national average for new clients is about 20 a month, well, that's where you sort of get about 15% of your patient visits each month, or should be new patient visits. And that's what's going to help develop the sort of feeder program, if you will, to keep your practice moving forward. The other reason to watch these KPIs in particular is it really helps with budgeting and forecast development. By using the number of active patients, it'll help you determine a forecast for revenue and staffing needs. You can see what kind of growth you're having, and it might be able to tell you at what point you need to add more staff. What are some of the actions that might happen because you're watching this? You're definitely your rescheduling rate should really be about 85%. So you want your active patients coming back. So if you're seeing that rate being a little bit low, you really want to go out and try to make sure that the pet owners are rescheduling their next appointment, or you have a system in place to encourage them to make that next appointment or to remind them about when that next appointment should be made. You're going to want to track those new appointments and where they're coming from. That'll help you focus your marketing activities. Lost patients, the reason you're sort of tracking that one, is there a reoccurring reason that you're losing patients, and does that need to be addressed? Following your active patient counts is just an important barometer for your practice. Second area here is staff production. The information you need to calculate the KPIs for the staff production are total revenue, number of full-time employees. You want that sort of broke down by veterinary, and then remaining staff. You want to have payroll cost and then the total number of transactions. The 4 KPIs that I've sort of picked out here to watch are revenue per staff, which is total revenue divided by full-time employees. As sort of a guideline, full-time employees are generally thought of being somebody that works 2,080 hours a year. We've found that with veterinary practices, getting real detail is not real hard. You're generally a little smaller in practice. It's pretty easy to define who's full-time and who's not. And if they're part-time, you tend to know who is working 3/4 or half-time, and it's not too hard to come up with that number. The second one is veterinary revenue as a percentage of total revenue. And you're sort of watching trends here, and that's probably going to be a key theme throughout the discussion here is watching trends. Is that going up or is that going down, and what can that tell you? Third one is revenue per full-time veterinarian, so which is total revenue divided by number of full-time veterinarians. National average on that one is about 530,000 to 575,000 per year. And then the last one, which may actually be the most important one in this group, is payroll as a percentage of total revenue. You're taking your total payroll, dividing it by revenue. In this calculation, when they talk payroll, they're just talking labor cost, not benefits included with that, no health insurance, no retirement fund cost, those type of things. National average is about 40%, so your payroll should be about 40% of your total revenues. You want to break that down a little bit further, it's a pretty even split between doctors and the rest of the staff. If you were to add in benefits cost, it's going to add about 6%. So you're going to look at about 44 to 46% of your cost is related to labor. Why we're going to look at this group is it will help identify areas of weakness. And I said the payroll is such a large percentage of your cost. It's a great indicator of your practice strength. It also shows how efficient your staff is. I said the staff cost should be about 18 to 20% of your production. That's non-doctor payroll cost. It indicates, say if you're low on that percentage, your staff might be being stretched too thin, or have your revenues increased and it's time to add staff. On the other side, if that percentage is getting too high, are you overstaffed, and do you need to review your procedures to adjust to improve productivity? What can we do about what are actions there? It's time to ask team members, get them involved, ask them for ideas about improving production, case acceptance, and patient care. You're going to need to help pet owners overcome financial worries or other barriers to treatment. Incentivize the staff. Set up a bonus system that's geared to meet your production numbers. And I always feel it's important to be more open about the production numbers with the staff and get them involved. The bottom line is that the more buy-in you can have from your staff as to your practice missions, and they believe they're part of something bigger than just getting a paycheck and coming to work, the more productive they're going to be and the more value they're going to bring to your practice. Third area is inventory optimization. For inventory optimization, the information you're going to need to calculate the KPIs is sales by item, inventory values at the end of the period, at least annually, and amount of waste or expired goods for that period, and then your cost of goods sold or your purchases for that period. The first one we're going to look at is inventory turnover, and that is simply the cost of goods divided by the average inventory. The average inventory is calculated as beginning inventory plus ending inventory divided by 2. And if you're going to do this on something other than annual basis, what you're going to end up having to do is take the results of that formula and then multiply it by the number of periods in the year. So if you're doing it on a quarterly basis, you would multiply it by 4. What you're looking there for is an inventory turnover of 8 times. Basically means whatever inventory you buy, you're going to buy and sell at least 8 times per year on average. If it starts getting lower than that, what's happening is you're tying up cash flow. Second KPI we're looking at is drug and medical supplies as a percentage of revenue, which is simply your drug and supply cost divided by total revenue. The national average for this KPI is about 20%. The next items, there aren't really much calculations, but just things to always monitor and watch. You sort of want a list of your top selling items and then also a list of your bottom selling items. And then the last one is always knowing how much waste or expired goods you're having to dispose of. Why we're sort of looking at these different KPIs, mainly just to avoid having excess inventory on hand. All you're doing with that is tying up cash flow. A lot better things to be doing with your cash than having it just sit in inventory. By watching your top and bottom sell items, it helps you to determine what product lines you may want to eliminate or which ones you may want to expand. It'll help ensure drug and medical supply costs are not left unbilled. So if you're watching that KPI on the drug and medical supplies and that percentage is getting too high, there's a couple of things that may be happening there. And one is that we find a lot is, are all the charges being billed out to the clients? Are things just not getting on the bills and getting left off? Another thing that can happen is you have not updated your pricing. Drug costs are going up. Are you passing that on to the client? The other one that can happen is too much of it's going to waste. You're ordering too much and it's not getting used up. I said like the big item here is helping cash flow. So if your inventory turnover is less than 8 times, it's time to review your inventory management system. You might need to automate it or sort of update the software. Again, like I said, that drug and medical supply cost, if that's off, you need to start watching that. The other thing you may want to take a look at is your practice on reordering. We come to the day and age where the turnover time between order and receiving the product is a lot lower. People are willing to ship smaller quantities, so you may be able to free up some cash by just ordering more often rather than ordering larger quantities. All right, on to the fourth one, financial KPIs. The thing I want you to think about as we go through this set is I want to have you think about these KPIs from 3 standpoints. You want to think about it from a management standpoint, from an owner standpoint. What is this telling you about your practice and how it's running? The second one is thinking about it from taxes. Practice is going great, you're making money, then comes April 15th and it's time to pay taxes. So I think that's important for you to be watching as you're going through what's my tax situation. Our general rule is we talk to everybody after that 3rd quarter, October, November timeframe, get a tax plan and give you guys time to work that tax plan and do what you need to do to help out the taxes by the end of the year. The third standpoint or viewpoint to look at it is from an investor or a banker. Eventually, your banker is going to want to see some financials or a tax return. It'd be a great idea to know, what they're looking at and what they're thinking about as they look at your situation. All right, financial KPIs. We're going to break those into a couple little chunks here. solvency issues, and then sort of return on equity or return on investment type ones. For the solvency one, the first one to look at is current ratios. By that, we are taking current assets divided by current liabilities. Current assets are defined as cash plus other assets that are expected to be turned into cash within a year's time frame. Samples will be accounts receivable and accounts inventory are the two big ones there. So you're dividing that number by your current liabilities, which are defined as debts or bills you're going to need to be paying in the next year. The big ones there are accounts payable and the current portion or the next year's payments on your loans. What you're looking at for this is ideally is to have twice as many assets as liability, a ratio of 2 to 1. If it starts dipping below, that's not necessarily bad. If it goes below 1 to 1, that's an area where I think you have some concern. Other ones you can do there is you can do debt to assets, you can do debt to equity, which is your total debt, your total liability divided by owner's equity. On that one, the bank is sort of looking for a ratio of 1 to 1 or 4 to 1, so they don't want 4 times the debt as you have equity in the firm. The next one is return on assets, which is net profits divided by your total assets. That's just showing if you are using your assets effectively and are earning a profit on them. The next one is return on equity, which is net profits divided by owner's equity. And that's just sort of showing, are the owners making a return on their investment? And then the last one is return on sales, or the famous EBITDA, which stands for earnings before interest, tax, depreciation, and amortization. The reason this one sort of gets a lot of attention is that it really pulls out some of those things that are more financing and management of assets or buying of equipment for the company, and sort of gets just down to, this is my revenues, this is how much it took to produce those revenues. National average you're looking on that one is about 10%. So in other words, for every $1,000 of revenue, you should have $100 of income. So why these KPIs? They really show an overall financial health of your practice. They show your ability to pay debtors on time, and the ability to earn a return on investment for the owners. Looking at these, here's some of the action items that may come out of it. If your debt to equity or your current ratio is a bit low, it's time to work on reducing debt. If you have a low return on assets or equity, it's time to review expenses for waste. But what I mean by that is it's time to grab that income statement or profit and loss statement and just start going through the line items and seeing what's happening there. Is there some expenses that aren't necessary that are on there that you could get rid of? When's the last time you had a review of your insurance? Is that cost got out of hand? Interest. When's the last time you looked at your loans and refinanced those, or reviewed whether the interest rate you're currently paying is within reason to the current interest rates that are out there? The other thing to look for is reoccurring cost. It's quite often we see some costs that are just coming out every month out of your bank account, and it happens to be for something that, or a service that you're no longer using. Maybe you bought or rented a piece of software and you're not really using it, but yet you're still paying for it because no one's just bothered to go in and make sure it got canceled. If you look back at the staff KPIs and you're sort of seeing some of these things work together, and if the payroll is too high for the production level, what should be done about that? Generally just speaking, just the financial KPIs will give you a good overview and should lead you sort of back to these 4 other areas of KPIs that you can then use sort of to pinpoint the issue. Staff production, if you start looking at those and breaking them down, you can see whether, is it something with the staff or is it something with the veterinarians. Move on to our 5th one, and this one is veterinary KPIs. Information needed here is you want to be able to break sales down by a number of different ways. Sales versus retail, you want to be able to break it down by profession. You need to break it down by species. Also the number of transactions for each of these groups. This group of KPIs is a little different. So far, we've sort of been looking at the practice as a whole, but this set of KPIs looks more at the individual veterinarian. Although you're going to start with doing it on a firm level, then you should be able to take this and do this by each veterinarian. The different KPIs in this section is a lot of ones we're looking at is the average client transaction. So professional services, we're just going to take revenues from the professional services and divide it by the number of transactions. Small animal practices tend to average about $154 per transaction. The next one you want to do is just retail services. So you're going to look at the revenue from retail sales divided by the number of transactions. And then you're going to want to be able to break it down by species and just look at revenues per species versus the number of transactions per species. And then you're going to want to take the next one here is the number of transactions per full-time equivalent veterinarian. You note up and above, that's about 150 per month. And the last one is active clients per veterinarian. And so you're going to want to sort of figure out the number of active clients per each veterinary, and you do that by taking the number of patient visits in 1 year divided by the revisit rate that we had calculated up above. And then you take that number and divide that by the number of full-time veterinarians. So what are we trying to do with this bunch of KPIs? We're really watching for a trend here and starting to compare it year to year and month to month, just to sort of find out what direction your practice is going. And with none of these trends, what you're trying to do is watch that trend. You're trying to find the movement that is happening, and you're trying to be able to attack that area of weakness before it becomes critical. Definitely, and these KPIs also definitely help with analysis of personnel and areas of practice strengths and weaknesses. Actions you can take here. Review practice areas that can be improved. Is one species doing better than another? Is one veterinary doing better than the other? And then should you continue with some of these lower producing areas, or maybe you need to specialize in other areas? And like I said, there's a difference between staff members here. And then, it leads to the questions of why. You definitely want to try to benchmark these against national or industry averages, and also watch those trends. The other point can be is if your average transaction seems low, is when's the last time you reviewed pricing? Is it something that is getting done on a regular basis, or is it something that hasn't been done in a while? That can cause your average client transaction to be a bit low. We went through this pretty quick, but just sort of a summary here with the correct KPIs tracked It really should help you set the appropriate goals, develop a strategy to reach them, and evaluate your progress. Without tracking your performance, you're really in the dark as to why or if you are having the success you want. I don't know if we had any questions that I should take a look at.
Yes, we have a question. If you could repeat how you calculate the inventory turns again, as well as revisit rate.
All right, yes. We will take that inventory turnover first. That one gets to be a little complicated. Yeah, you're looking at your cost of goods sold. So if you look on your income statement or profit and loss statement, sometimes it's called that, they should have an item there for your cost of goods sold items. So that's sort of your numerator. Your denominator is beginning inventory plus ending inventory divided by 2. So that's your formula on an annual basis. If you're doing this, say, monthly or quarterly, you're going to want to do that same calculation for, say, the quarter. But once you get the answer, you're going to want to multiply it by 4 quarters in the year. Will get you to then your annual average. And the other one was revisit rate, I believe.
Correct.
All right. So that one, you're taking the total number of visits and you're wanting to divide that by active patients. And like I said before, is the active patients are generally defined as a patient that has visited in the last 18 months. What's really important to make this calculation work is to keep your database clean, which the general area where you see this not be so accurate is lost patients. If someone is not going in there and cleaning that portion up and noting which patients are no longer active, and then if you can't add a reason why. Otherwise, if you just keep that database growing, this number, it's going to be hard to come with figure out the number of active patients. You just looked at your database, you could have all your patients you've seen over the last 10 years in there. So you want to be able to come back and make sure you know what your active patient list is.
Do we have any other questions? We'll give people just a moment to type them in the area. A reminder, if you're not sure how to type up the Q&A area, place your cursor on your screen. Along the bottom should be some circles that pop up, and one will be black and have 3 dots, and you can click on that.
Okay.
In there. A reminder that if you do have some questions for Mr. Kelling, he will be exhibiting at the annual meeting just real quick here in a little over a week. So you could visit him in the exhibit hall.
The other thing I was thinking about too is, through this, I throw out all these KPIs and things to do is, I was also thinking about, well, how do you get started monitoring these KPIs? I guess my suggestion there is gather the last 2 or 3 years of financial statements, start going through this list, picking some out that seem relevant to your practice, and start tracking. Go back and calculate them for the last couple of years and see. The other thing you're going to want to do is develop a way to track them. It might be simple as a spreadsheet. I also know there's software programs out there that will monitor your KPIs. We actually use one for the firms that we work with. So once we get done with a set of financials, we'll produce these so that you can watch them. And just remember, you definitely are watching trends, trying to sort of find something that's not maybe going quite right or sliding in the direction that you don't want, so that you can try to correct it before it becomes a bigger issue. And the last thing you probably really want to do is set some goals after you've got those last couple of years and you can see where you're at. Set some goals so you can monitor against those.
That's great advice on how to get started. At this point in time, I'm not seeing any more questions, so I would like to thank Mr. Killing for talking with us today. Oh, never mind. I take it back. I got another question. What is the typical number for veterinary revenue as a percentage of total revenue? When you say veterinary revenue, is this just professional services?
Um, that one was a tricky one. It sort of depends on the practice. I think when you're looking at small animals, um, man, it just varies, and some sell more than others. Um, I always was looking more like, I think about 85% should be from veterinary revenues, but that one is a really a tough one. It just some practices just do a little better in selling, food and those type of things. Yes, that's one area where I don't want to say disappointed, but a little discouraged in. I'm trying to get you some national averages, and it is sometimes difficult to find. I would say if you're a member of the AVMA, that they have a lot of good resources out there for members. And I know they're definitely trying to develop some of these national averages. They've actually went out and developed a standard chart of account, and they're trying to encourage practices to use it so they can sort of develop these. So if you have that as a resource, definitely go and look in that. And they might even have it broke down a little better by type of practice and location.
Great. Actually had a couple other questions come in. Beyond provider production, what metrics do you recommend that they share with staff?
Those ones to share with staff, I think when you're looking at the production numbers, I think you're looking at, how many visits are we having, goals for new clients or new patients. I think that's those are the numbers to really watch. The average transaction cost, you may not want to give out the actual number, but maybe you start with giving out, is it growing or decreasing? Hey, we like to get this up 10% and work more with percentage than sort of giving out actual dollars. I know sometimes that can be tricky if you're giving out, how many visits you have, and and everybody knows what the average price of a visit is. That's sometimes some information you don't want out there. But I would start looking at, your average visits, your total number of visits, your number of active patients, so they can see these things growing. I think that's really where you want them to head.
Great. I'm just double checking to make sure that we don't have
Another one that I thought might be sort of interesting to track would be, especially for a small animal practice, is, I don't know how easy or how well software would manage software would do it, would be average age of a patient. I think if you could see that growing, that would be a point of encouragement for staff. Hey, what we're doing is helping the animals live longer and healthier, happier lives.
Great point. So one last question that came in is actually more for me. I do record these webinars, and I know it's a lot to take in that we covered, and sometimes you like to go back to it. So you can rewatch them. I usually have them posted on our YouTube channel within a day or so. It all just kind of depends on what else I get pulled into in the office. So it should be up by the end of the week. If you have any questions about that, you can reach out to me and I can help you. Seeing any, just let me double check one more time. Sure I don't skip anybody. That is it for questions. So thank you very much, David, for joining us today and helping people think through key performance indicators. A reminder to people, I will be sending you your CE certificate. I will also reattach the spreadsheet that was shared earlier in case you missed it come through. And if you have any questions, you can get back to us at any time. Thank you, guys.
Yep, feel free to give me an email if a question comes up. Although I see an error on my email address, it's not KBID, it's LTD, much like the end of our website.
Okay, great. Thank you very much. Have a good day.